Welcome to this edition of Fundamentally Speaking with Calvin Schnure, NAREIT's Vice President of Research and Industry Information. Calvin, thanks so much for joining us. So here in D.C., the weather has officially turned to winter, but the real flurries have been in the headlines. We've seen some good news come out for the economy. What's your take on these reports, and what are the most important trends?
That's right. There have been a flurry of economic reports, but these aren't the kind that shut down the city for a day or two. One of the most important one has just been that job growth has firmed. We saw payroll employment increase by 203,000 in November, and this is after a string of months that have been back around the 200,000 mark. In fact, the past year or so it's been running around 200,000, which is quite a bit stronger than it had been a year ago. That's not the only sign we're seeing. The economy itself grew much faster in the third quarter than anyone expected, 3.6%. Now, part of that boost was from inventories. Some people are really worried about that. You're not going to see a repeat of that inventory contribution in the fourth quarter. But even excluding that, looking at the private sales, it was growing up almost 2%. This is good, solid baseline growth. We've had other reports that have been strong. Auto sales are up around 16 million units. Now, sales 10 years ago were running 16 or 17 million units and then slowed quite a bit. So there are a lot of old cars on the road. People want to replace those cars, and the fact that we're seeing sales back to 16 million says that they have the money and the confidence. That's solid for the consumer going forward. And just finally, the budget deal that Congress has just reached does a couple of things. It removes some of the uncertainty that was really plaguing the whole economy last year. And by reversing some of the sequester cuts, it means the government is not going to be throttling back the economy this year.
Now, you mentioned uncertainty, so let's flash back to the beginning of this year when there was certainly a lot of uncertainty around fiscal cliffs, sequester, and that resulted in a lot of very pessimistic views about what might happen. You took a bit of a contrarian view. What was your argument then, and how has that played out?
That's right. I did differ from consensus. And just to recap the view, was people looked at the increase in the payroll taxes and the sequester, and they didn't even know about the government shutdown when people were talking about this, and said these impacts are going to take more than a half percentage point off of GDP growth. So people are talking about slower growth ahead. Now, it's true that they were going to take more than a half percentage point off of GDP growth. But what I said at the time, we put it on our website, was this will subtract more than a half percentage point from baseline, but the baseline is strengthening. So a year ago, we did have two things. The government was going to be subtracting from the baseline, but baseline was even stronger than what this was subtracting. What did we see at the time? We saw some improvement in the labor market. It wasn't hitting on all cylinders, but there was some improvement. There were signs that housing was not contracting. There was some confidence coming along. And that really is how it turned out, that we did see the government subtracted quite a bit through the first half of the year. And then as the year went on, we got quite a bit of acceleration. So it's turned out reasonably in line with what we were looking at a year ago.
Now, shifting ahead to 2014, there's certainly no shortage of challenges that still lie ahead. What do you think are the key themes to keep an eye on?
Well, we still have two real points going on. One is the baseline is still getting stronger. In particular, the housing market is now going from having finished its drain and stumbling forward to looking like it could have a fairly solid 2014. You look at the new home sales number that came out recently. The inventories are fairly weak. You look at the time it was on the market. The median time on market for home sales tends to run 5 or 6 months. It was less than 3 months. It was about 2.5 months. That means builders are selling homes almost as fast as they can put them up. That says that there's strong demand from potential homeowners, and we're going to see more construction, and that's going to have a lot of feeder effects into appliances, durable goods, everything else. This is a general good confidence. There are other factors I mentioned earlier about the baseline being stronger, but instead of the government subtracting, now what we're likely to have is the government adding, say, a quarter percentage point to GDP growth. So you put those together, a higher baseline with some slight positive contribution from government, and it looks to me like 2014 could be the first year that feels like a real recovery.
And lastly, bring it home for our REIT.com viewers. What's all this mean for commercial real estate?
Well, a stronger economy has got to be helpful for all the real estate sectors. That's just a given. You're going to see stronger absorption. One area where you'll see it is office that has so far been concentrated in central business district. The recovery will spread to suburban and tertiary markets. Retail will benefit from stronger consumers. Multifamily sees more supply coming on, but that supply is in a tug of war with the demand, and so stronger payrolls, stronger employment means that you may not see too much of a pressure on rents from that supply. Overall, it looks to be a fairly good year for commercial real estate.
Calvin, thank you so much.
Thank you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.